Today, folks, as always, we're going to be reviewing the $305,000 stock portfolio I built, but we got to get into the stories driving the market this week from a Hindenburg report absolutely destroying SMCI. We're going to talk about fake sunlight, NVIDIA, PCE, and just where the markets have landed. And if that is a conversation you'd appreciate on your path to financial independence and damn well one day retire, always hit that subscribe button, folks. Join me because we got some fake sunlight. This came across my desk, and I've been gutting myself on the vaporware, the unlikelihood of this ever happening, and the fact these dudes are raising capital right now, claiming using satellites that they can literally give you 24-hour sunlight. And there's been a lot of videos coming out defaming this idea that it's just absolutely ludicrous. An engineer from SpaceX that was found to be just an unpaid intern was really pumping up some vaporware here because they try and give you a little demo they showed on Twitter.
Google has a new lighting service where you can like play with the spot.
Oh, awesome.
But yeah, watch this. Just bring it over to us here. Isn't that crazy?
No way.
Yeah,
It's clearly not that bright. I mean, I don't know how you could magnify the light, let alone destroying, light pollution ecosystems that we're already doing, let alone the fact that I don't know if it's bright enough to charge solar panels. There's just so much wrong with this. Imagine trolling people now and giving them just shining light on people's houses at night. So this guy does a whole video just talking about what a scam this is. And when I saw it initially, I was like, this is wild. Like, this is absolutely absurd. So they're trying to raise capital right now. And I honestly don't think it's going anywhere. Apparently the guy that's trying to start this up already ran a few failed startups, but just really weird, interesting things that, the world we live in is changing in sometimes directions I don't think we need it to go in. But we also have Supermicro coming out of the Hindenburg research. And when Hindenburg posts something, man, if I could be a fly on the wall in this office, I would be shorting the crap out of the stocks, because anytime they talk about something, it just devastates. They've taken down so many different companies like Nikola, and anytime they post something, it's just utterly fascinating. So they're claiming that Supermicro, there's fresh evidence of accounting manipulation, which is really interesting. And this has led SMCI to tank 30% this week, just clearly showing, there's always volatility in the markets, and this stuff is kind of unpredictable. And I love that there's people sitting there like Batman, ready to just come down with the hammer and gavel and just, slap people back into reality sometimes, leading into the whole NVIDIA conversation, because NVIDIA, they actually continue to post absurd numbers, yet the stock was down. And I want to try to explain why the stock is down, because they beat expectations pretty decently by 5%. And obviously expectation beats have been going down as, the analysts and everybody are being able to track and get more in line with NVIDIA's growth, because we can see, the revenue, $30 billion. Insanely quarterly revenue growth, up 122%. When you look at net income, they're still $5 billion away now from basically getting to Apple's level of net income, being, I think right now, is still the third largest company in the S&P 500 index, up there with Apple and Microsoft. I'd have to double check. Are they still in line even after this drop? If we take a look at their market cap, it's $2.89 trillion. So where does that put Amazon, for example? Because I think Amazon held the title of the third largest. Yeah, so at 1.8 trillion. So not even close. Not even close. It's crazy how big of a company NVIDIA is, with a 55 times multiple. If it continues the growth rate that it has, you could almost justify the value here, but that is presuming that the AI revolution and these chip demand stays up, presuming that these other companies don't see huge growth in their own chips, because as mentioned, Meta, Amazon, all these companies are introducing their own chips to make up some of the supply slump, and NVIDIA can't even get the new chips out, so people are still buying things like H100s. But honestly, I think what we're looking at here is just overbought territory. I think you get to a phase of hype where you just kind of finally reach parity with the buyers and sellers. But the valuation, this is actually pretty modest for the history of NVIDIA. So it's going to be really neat to see. I don't play this outside of my indexes. It is my third largest holding just because of the S&P 500 exposure. We'll talk about more of that once we get into the portfolio. We also had PCE data come in here, which was actually very favorable, which is another implication of interest rate cuts, because core and personal consumption expenditures price increased 0.2% in July and 2.6% from a year ago. The 12-month figure was slightly softer than the 2.7 estimates, which is great. All item inflation came in respectively at 0.2% and 2.5% in line with forecast. Personal income increased 0.3%, slightly higher than the 0.2 estimates. So everything across the board here is looking fairly favorable, and obviously they should have been cutting interest rates a while ago. but this still is potentially the first soft landing in U.S. history through an interest rate cycle like this, which just goes to show past performance does not equal future return. If we look at the markets this week, dividend stocks continue to outperform the broader tech companies. As we can see, most tech companies haven't rallied at all this week. On the Canadian side of the border, we're seeing energy get absolutely hit, while banks posted earnings coming back with an absolute vengeance. We've seen CM, some of these banks are up like 8% this week. Royal Bank's up 3%. Great performance with the exception of BMO, but the broader sector's crushing it. If we take a look at oil, you should be seeing these numbers finally start to come down at the pumps. So congrats to everybody out there. This is a win for inflation. It's a win for my gas tank. We were driving yesterday and couldn't believe some of the gas prices we were seeing. So hopefully this trend remains. I'm not a guy that enjoys higher gas prices, but that comes with the implication of, yes, I'll be saving more at the pump, but my portfolio might be getting hindered a little bit. And let's talk about the portfolio, because we are at continual all-time highs here, baby, and everyone kind of makes fun of me for just buying index funds for the most part, but I am not a gambling degenerate like you Jim Cramer clowns out there, and I am more fixated toward, passive, truly passive, unmanaged income for the most part, with the exception of a handful of the individual stocks that I still own. But with those index combined, I should offer some updates now and again, because we're sitting around $305,000, and again, over 10 to 11% of the portfolio just sits within Apple, Microsoft, and Nvidia, and I do not have to own these on an individual basis to give myself that kind of exposure. And we were talking in my private WhatsApp chat group with 6 and 7 figure investors how highly concentrated you are these days just buying the S&P and some of the risk that comes with that. So what I've tried to do here is limit that kind of tech exposure, because I think 20% sector exposure is enough for my comfort level. It's a very healthy position that kind of removes some of the volatility from the portfolio, right? So even with me only owning 53% the S&P, 20% is still the largest exposure I have in my portfolio as a sector, and it's technology, right? Next in line, we have financials and then healthcare. Ideally, what I want to do is I don't like the energy exposure that's obviously coming from VDY, because it's got a lot of energy exposure and some of these other ETFs. But what I really want to do is continue to build up my exposure to XLU, which is a recent position I've been adding, because I think energy is probably one of the most profound sectors that you can get exposure to. Because not only is it highly unvolatile, so it removes the volatility from the from my portfolio, but it gives me great performance. Like, it actually has exceptional performance that I think is going to continue to be excelled by the onslaught of the electrification of everything, right, and the energy demand that is going to be required. So when we take a look, XLU I've only got about 10,000 invested in it from the Canadian dollar perspective. It's only about 3.2% of the portfolio. That's where most of my focus is going to go for the next few onslaught of investments that I do make, just to kind of get that up probably closer to maybe a 5, somewhere between 5 and 10% as I continue to add to the rest of the portfolio itself. But I like this kind of 4-fund strategy. It's really simple. It really helps me sleep a lot easier at night. We're getting across the board about a 2.4% dividend, so over $500 a month, which is a healthy place to continue to help me reinvest. If we take a look at the performance of the positions this week, SCHD and my utility ETF are the two performers. Obviously, the S&P is lagging a little bit here. VDY is just lagging a little bit, but when we zoom out on the month, we actually start to see the performance shift here, because the S&P is up 3% against the utilities that are up 5%, and these dividend ETFs are still doing pretty exceptional here. It's nice to see that SCHD is kind of finally propelling back to some new highs, with XLU, which I wish I bought a little earlier on, because it's actually beating all of the sectors right now, including the S&P, basically year to date, right? It's been in line with the S&P, and the 6 months has actually been outperforming. So we're in a very intriguing place overall. I mean, I'm loving the markets here. I think we're heading into an interest rate recovery cycle. Basically, all the interest rate sensitive stocks I think are going to start to lift off over the next 1 to 2 years. And we're starting to see that already, especially if you take a look at some of these real estate ETFs, which honestly, if you don't have real estate exposure, I think paying attention to these right now, and a lot of people say it's priced in, but I'm telling you it's not. These stocks are highly suppressed. Yeah, the first interest rate cut might be priced in, but I'm telling you, we're going to head into continual interest rate cuts for another year or two, which is going to continue to benefit these kind of companies. So this is where a lot of my interest is lying right now. I'm very happy with where everything is at for my personal risk tolerance. Obviously not financial advice, but I'll pass the question off to you. I'd love to know what you're doing, how your portfolio's been doing this week, and what's got your interest. Is it these crazy new business ventures that seem kind of crazy? Are you guys into the chip sector, or are you just kind of a boring grandpa investor like I am, just buying these broader base ETFs? But I'd love to hear about it. Stay cool, stay awesome, folks, and enjoy your weekend.